So a question I get asked probably on a daily basis is, what is an affordability calculator? How do lenders actually calculate how much I can borrow? Because there's a typical myth, everyone says, can I get 4.5 times income multiples? Can I get 5 times income multiples? Now, the truth is, every lender assesses affordability in a different way, right? There's no set way each lender assesses affordability. Every lender has a different sort of criteria. But what I want to show you all today is typically what a lender's affordability calculator looks like, how a specific lender will actually calculate your affordability. So here we go. Let me show you a calculator. Now, this is an actual mortgage lender's calculator. Right, it's not one that I've created. It's an actual mortgage lender's calculator. For compliance and legal reasons, I can't actually show you the mortgage lender's name on here, but this is typically what a mortgage affordability calculator looks like for the mortgage lenders. Obviously, it looks different for every mortgage lender, color wise, logo wise, and things like that, but generally this is how things look, right? So what I want to do today is I want to run through this whole mortgage affordability calculator and explain to you guys what actually each sort of section means and why certain things are sort of entered in, and then you'll know how lenders assess your affordability. So for example, right, I've input some details already. Loan to value. So how that works is that's calculated depending on how much you're buying the property for and your deposit. So we're going to use easy figures here. If your property was worth £400,000 and you needed a 90% mortgage, right? So that means a loan of 360,000. Then you would put 90% here, which means you technically have £40,000 as a deposit for a property worth £400,000, right? Now, for this calculation, we're just going to assume the repayment method is capital and interest. So the easiest way to explain this is the capital and interest. When you originally get a mortgage balance, it reduces over time. So it just goes down and down, because the ideal goal is for a lot of people, for their residential home especially, is you want to be able to own that home outright with no mortgage at the end of the mortgage term. Because the goal is you've got a mortgage-free property, then you've always got a roof over your head. We've got capital and interest. So as mentioned before, this is the repayment method. So we're going for a loan of, for example, £360,000, 90% loan to value on a property worth 400,000. Now, the next section is term. Every lender will allow you to have different terms dependent on your age, right? Typically, the majority of lenders, so this is typically the majority of lenders will let you go to age 70. Some mortgage lenders will let you go to age 75, and some lenders will let you actually go to age 80 on earned income. Now, typically, the maximum number of years available on a mortgage term with the majority of lenders is 35 years. Some lenders do allow you to take a 40-year term as well. Shared equity. So this section is basically if you're buying like on shared ownership or the help to buy scheme, because mortgage lenders assess things in different ways. So for example, if you're taking a shared equity scheme, they may reduce your income multiples on what they'll allow you to borrow. If you're taking help to buy, for example, they may stress the help to buy loan in the background, because potentially after 5 years, that would be a commitment if it's not repaid. So they'll take it as worst case scenario for if you've repaid the loan or not. Next section we've got here is applicant details. So you can see here, look, number of applicants. It's either me buying on my own or me buying with my partner, with my wife, right? So that's pretty self-explanatory. The next section is if you've got any kids. So dependents means usually any dependent is like someone who lives with you under the age of 18, so children. However, you potentially could have adult dependents as well. So if you look here, you could go up to, well, this lender lets you guys up to 15 dependents. I'm not sure if any of you have 15 dependents, but technically speaking, this could affect how much you can borrow. So for example, kids, right? Now, especially in the current climate, this applicant one self-employed bit, what this means is a lot of lenders want to know if you're self-employed. The reason being is potentially that could restrict how much you can borrow, especially because of the current pandemic. A lot of self-employed businesses have suffered. So unfortunately, even if it wasn't no fault of your own, a lot of lenders, not all, but a lot of lenders potentially will restrict the income multiples available to you for the mortgage loan. So for this example, we're just going to assume the applicants are employed, so we're just going to put no. but that's just to let you know regarding the self-employed situation as of today. So main income, you've got your basic salary. So for this, we're going to assume that both applicants are employed. You've got your basic salary, so we put 30,000 there. Now the second box typically is like if you've got any overtime, any commissions, any bonuses. So every lender will assess these incomes in a different way. Now with certain lenders, they will need you to have like a 2-year track record. Some lenders will let you take the latest years. All depends on what you need as a loan, and your advisor will obviously act accordingly and choose the right lender for you based on that. But any additional income which is on top of your basic is calculated and usually put in this second box, right? Same again here, joint applicants, we put their income, employed income in here. Now the next section, expense details. So monthly loan repayment. So here you would enter, for example, any personal loans you may have, any credit agreements you may have, you know, furniture, things like that. And then you've got here, look, your monthly hire purchase. So your car loan, for example. So for example, you could have a PCP or something like that. You put that in there. And same again here, like anything you've got on a lease arrangement for like a car, exactly, again, you can put that in there. Now, other mortgage payments. This typically is for any other residential properties you may be owning on completion of the mortgage. So for example, you know, if this was my second home that I was buying and I have a mortgage in the background that I know that's going to be my property on completion, then I would need to enter at least the mortgage payment in there. So for example, if my mortgage payment was £850, then your advisor would put £850 in there. Now typically each lender operates in a different way. Some lenders will only stress the mortgage payment in the background if that's all you have a commitment to. Then alternatively, some lenders will take the overall running costs of that property. So any bills, any utilities, you know, any council tax bills, things like that, all that will be factored in. But typically every lender works in a different way. So for this lender on whose calculator I'm using, they only use the monthly payment. Maintenance and other expenditure. So in this section, you would put any childcare costs that you may have, any nursery school fees. A lot of you, for example, on your payslips may have childcare vouchers. You would enter that here. If you've got, for example, maintenance agreements, right? So spousal agreements, maintenance agreements, things like that. So if you're paying something monthly to an ex-partner, you would put that in there as well, because that would be seen as a commitment. Because when you take your mortgage with your new lender, that is going to continue to be paid. So that needs to be factored in the overall affordability assessment of the loan of what you're going to take. This section, credit card balance. Now what this is if you've got any balance as at the time of application, right? So if the balances are going to be cleared, then we can put that as 0. If they're going to remain on completion, so for example, you've had a credit card with 300,000, that would be a big credit card, £3,000, right? So if you had a credit card of like £3,000 and you know that you're not going to be able to repay that on completion, we have to factor that in, because that will potentially be a commitment when you take out your new mortgage. So we need to sort of anticipate that as well, and in terms of what the monthly payment will be on there. So typically what lenders will do is they will take 3% and use that as a monthly commitment in the monthly cost for you. So that could impact how much you can borrow as well as a mortgage loan. And then if there's any personal changes or anything like that, so potentially if you said yes, then we have to basically enter it here. But if you said no, for example, then it's just a case of, then you go calculate. So on this basis alone, you can see, look, we've got a 90% loan to value, capital and interest mortgage, going for a loan of £360,000 over a 35-year term. We've got joint applicants with one child. Both of them are employed at £30,000 per annum. We've got monthly loan repayments of £300. We've got a car purchase payments of £300 a month as well. And you've got your other mortgage payment of £850 a month and a credit card balance of £3,000. So what this lender is basically saying is, this is how much you can borrow as a maximum loan based on your current commitments. Now, if we reduce some of these balances, for example, just assume that they weren't there, then this could potentially increase how much you can borrow. Let's see. Oops, it enter 0 there. So here we go. See, as you can see, this is why the affordability calculator differs for everyone. So a lot of you probably, you know, friends and family say, yes, you can definitely get 4.5 times income, you can get 5 times income. It's all down to individual affordability and how much you can borrow, but also what your expenditure is at the same time. Because just remember, what your expenditure is different to anyone else's, right? Like for myself, I've got a child, she goes nursery, but my next door neighbour doesn't have nursery costs. And obviously they may have said to me, oh, you can get 4.5 times income. That's not the case, unfortunately, for everyone. You have to make sure that the mortgage is affordable going forward to ensure that you can actually maintain your monthly payments when you actually do get the mortgage loan. Because what lenders don't want is to offer you a mortgage that you potentially can't afford to pay back, you know? Because what happens is, if you can't afford to pay it back, you're probably going in arrears. Once you start going in arrears, eventually the lender's going to repossess your property, and that's not what they want. They just want a nice life where you can afford your monthly payments, but at the same time, guys, you want to ensure that you can actually sustain your level of living. You don't want to be stretched every month. You want to ensure that you can get the mortgage you want, but be able to live in the home as well at the same time. So I hope you found that useful. You know, this is just typically one lender's calculator. As I said at the start of this video, every lender operates in a different way. They take different incomes into consideration, but for all our videos going forward, we're going to use this one specific calculator. I hope you found that useful, and you know, subscribe for more if you liked it. Thank you, guys.